Hey everyone, welcome back. Today we're taking a deep dive into USA mortgages and home loans.
Sounds exciting.
It is. Now, we know you guys are pretty savvy when it comes to this stuff, so we're not going to cover the absolute basics.
Right, I'm going a bit deeper.
Exactly. We're going beyond Mortgage 101 and really digging into those finer points that maybe don't always get enough attention.
I like it, uncovering those hidden gems.
Yeah, exactly. And we'll be drawing some really insightful points from the podcast episode, Understanding Mortgages and Home Loans in the USA. So are you ready to get into it?
Absolutely. I'm ready to unpack those complexities.
Perfect. Okay, so let's start with something we all know. A mortgage is basically a loan you take out to buy a house, right?
Right. But it's more than just a loan. It's a secured loan.
Okay, a secured loan, that sounds a little intimidating. What does that actually mean for me as a borrower?
Well, it means that the house itself acts as collateral for the loan. So if for some reason you can't make the payments, the lender could take back the house.
Ah, okay, that makes sense. So it's a bit of a two-way street, right?
Exactly. It's a calculated risk for both the borrower and the lender. But think about it, that security is what allows lenders to offer those large loans, often hundreds of thousands of dollars, which helps people who couldn't afford to buy a house outright to actually achieve home ownership.
That's a good point. It's like a partnership in a way.
Yeah, you could say that.
Yeah.
Now, another key thing to understand is how those payments you make each month are divided. They're split between principal and interest.
Right. Principal and interest. Two words we hear all the time, but could you break those down for us? What do they actually mean in the context of a mortgage?
Sure. The principal is simply the original amount of money you borrowed. So let's say you take out a mortgage for $250,000. That's your principal. Interest, on the other hand, is what the lender charges you for lending you that money. It's basically their fee for providing the loan.
Okay, got it. So the interest is like a percentage of the principal, right?
Yeah, precisely. And that interest accrues over time, which is why you'll often hear about the importance of the loan term. The length of your mortgage, whether it's 15, 20, or 30 years, significantly impacts how much total interest you'll pay over the life of the loan.
Right. So a longer loan term means smaller monthly payments, but more total interest paid in the long run. And a shorter loan term means higher monthly payments, but less overall interest.
It's like choosing between a slow and steady marathon versus a quick sprint.
That's a fantastic analogy. You've got it.
All right, so now that we've got those basics down, let's dive into the different types of mortgages. I know there are a few options out there, but the two big ones we always hear about are fixed rate and adjustable rate mortgages. What's the real difference between those two?
Well, as the name suggests, a fixed rate mortgage has an interest rate that stays the same for the entire duration of the loan. So if you lock in a rate of, let's say, 4%, that rate will remain at 4% for the next 15, 20, or 30 years, whatever your loan term is. So with a fixed rate mortgage, you have that predictability and stability. You know exactly what your monthly payments will be, which is great for budgeting. But then, wouldn't everyone always choose a fixed rate mortgage? Why would anyone ever opt for an adjustable rate mortgage?
That's a great question. And you're right, fixed rate mortgages are often the more popular choice, especially for first-time homebuyers. But adjustable rate mortgages, or ARMs, have their own advantages. They usually start with a lower introductory interest rate, which can be appealing, but as the name suggests, the rate can adjust after a certain period of time, typically after a few years.
Okay, so that's where the adjustable part comes in. But isn't that a little risky? I mean, what if the interest rates go up? Wouldn't my monthly payments skyrocket?
That's definitely a possibility. With an ARM, your payments could decrease if interest rates fall, but they could also increase if rates rise. So you're right, there's more risk involved.
So it seems like ARMs are best suited for those who plan to sell their home before the rate starts adjusting, right?
Exactly. You could enjoy the lower initial rate without being exposed to the potential increases later on.
Got it. So it's all about weighing the pros and cons and figuring out which type aligns better with your individual circumstances and financial goals.
Precisely. And it's important to remember that there are other mortgage options out there besides just fixed rate and adjustable rate.
Oh, right. Like what?
Well, there are government-backed loans like FHA loans, VA loans, and USDA loans.
Yeah, I've heard of those, but could you give us a quick rundown of what each one is all about?
Sure. So FHA loans are insured by the Federal Housing Administration and are designed to help make homeownership more accessible, especially for first-time buyers. They often have more flexible qualification requirements and allow for smaller down payments. VA loans are guaranteed by the Department of Veterans Affairs and offer favorable terms to eligible veterans, active duty military personnel, and surviving spouses. And USDA loans are specifically for homes in rural areas and aim to promote homeownership in those communities.
Wow, it's amazing how many options there are.
It is. And just when you thought we covered them all, there are also jumbo loans.
Jumbo loans, huh? Those sound big.
Well, they are. Jumbo loans are for those looking to borrow, jumbo amounts of money. They exceed the limits set by Fannie Mae and Freddie Mac, which are the government-sponsored enterprises that back most conventional mortgages. So these loans are typically used for higher-priced properties, those million-dollar homes and such.
Oh, I see. So even if I'm not buying a mansion, jumbo loans could still be on my radar if I need to borrow a larger amount than those conventional loan limits allow.
Exactly. The world of mortgages has an option for pretty much every need.
Okay, so now that we know what kind of mortgages are out there, let's talk about actually getting one. Where do we even begin?
The journey to mortgage approval starts with pre-approval.
Pre-approval. Why is that so important?
It's like getting a financial sneak peek for both you and the lender. You provide some basic financial information, and the lender gives you an estimate of how much you can borrow. It helps set realistic expectations.
So pre-approval is like getting a reality check before you even start house hunting.
Exactly. It saves you the heartache of falling in love with a house you can't afford.
That's a good point. All right. So let's say I've done my pre-approval, I found the perfect house, and my offer gets accepted. What's next in this mortgage marathon?
Then it's time to get serious and fill out that official loan application.
Okay, so what happens during the loan application process? What kind of information do I need to provide?
You'll need to provide detailed financial documentation, proof of income, tax returns, bank statements, and all that fun stuff. Basically, the lender needs to verify everything you stated during pre-approval.
It sounds pretty thorough.
It is. This kicks off the underwriting process. Underwriters are the detectives of the mortgage world. They carefully examine all your financial information, assess your ability to repay the loan, and verify the property's value.
Okay, so it sounds like the underwriters are the gatekeepers, making sure everything is legitimate and the loan is a good risk for the lender.
Precisely. And once you clear underwriting, you're almost at the finish line.
Almost. So what's the final hurdle? What happens after underwriting?
The grand finale closing. This is where you sign all the final loan documents, pay closing costs, and drumroll please, you get the keys to your new home.
Wow. What a journey. We've covered a lot of ground here. But before we move on, there are some common mortgage terms that we really need to break down.
I agree. Let's demystify that mortgage jargon.
Okay, perfect. We've talked about principal and interest.
Yeah.
But there are a few other terms that I always hear but don't fully understand, like escrow. What exactly is escrow?
Escrow. Okay, so think of it like this. It's a separate account that your lender manages.
A separate account.
Yeah, and you pay into it each month as part of your mortgage payment.
Okay.
And that money is specifically for things like your property taxes and homeowner's insurance.
So it's kind of like a forced savings plan.
You got it. It's a way to make sure you're always setting aside enough money to cover those important expenses when they come due.
That's really smart, actually. I never thought of it that way.
Yeah, it protects both you and the lender, making sure those essential bills are always paid on time.
Makes sense. Okay, so we've got principal, interest, and escrow. What about PMI? I've heard that term thrown around, but honestly, I'm not quite sure what it is or if it even applies to me.
PMI, or private mortgage insurance, is something you'll typically encounter if you're putting down less than 20% for your down payment.
Less than 20%.
Yeah, it's basically an extra insurance policy that protects the lender.
The lender, not me.
Right. It protects them in case you default on the loan.
Oh, okay. So if PMI is for the lender's benefit, why do I have to pay for it?
That's a fair question. PMI essentially allows lenders to offer loans to borrowers with smaller down payments because it reduces their risk. So it actually makes homeownership more accessible to more people. It's like a trade-off. You pay PMI for a certain period, but it enables you to buy that house sooner, even if you haven't saved up a huge down payment.
I see, that makes sense. So it's like a stepping stone to homeownership. Okay, now let's get to the good stuff. What are your top tips for getting the best mortgage deal? Spill the secrets.
All right, let's dive in. First and foremost, your credit score. This is huge. Think of it as your financial resume in the eyes of lenders.
Right, I know credit score is super important. But beyond just paying my bills on time, are there any other specific things I can do to boost my score?
Well, Paying bills on time is crucial, but you can also focus on keeping your credit utilization low. That means not maxing out your credit cards. Try to keep your balances well below your credit limit.
Okay, makes sense. So it's about showing responsible credit management.
Exactly. And you know those old credit cards you haven't used in years? Don't be tempted to just close them.
Oh, really? Why not?
Closing those old accounts can actually lower your available credit, which can hurt your score. It's best to keep them open, even if you're not actively using them. And another thing, always check your credit report regularly.
Yeah, make sure there are no errors or inaccuracies that could be dragging down your score.
Exactly. You want to present the best possible financial picture to those lenders. Okay, tip number 2, save for a larger down payment. The more you can put down up front, the lower your loan amount and monthly payments will be.
And what we talked about earlier, a larger down payment can help you avoid PMI.
Precisely. It's all about minimizing those extra costs. Okay, tip number 3. This one is crucial. Shop around. Don't just settle for the first mortgage offer you get.
Oh, that's a good point. I wouldn't buy a car without comparing prices at different dealerships.
You got it. Rates, terms, and fees can vary significantly between lenders. Get quotes from multiple lenders to make sure you're getting the best deal possible.
So important. Okay, what's your last piece of advice for securing that dream mortgage?
This might sound obvious, but understand your budget. Just because you're approved for a certain loan amount doesn't mean you have to borrow that much.
Oh, that's a really good point. It's easy to get caught up in the excitement of buying a house and overextend yourself.
Right. Take a step back and figure out what you can comfortably afford each month after factoring in all your other expenses. Groceries, utilities, transportation, entertainment, everything.
Don't just focus on the mortgage payment itself. Think about your overall lifestyle and financial well-being.
Absolutely. Buying a home is a huge financial commitment, so it's important to be realistic about what you can truly afford. And speaking of commitments, here's one final tip that applies throughout the entire mortgage process. Read the fine print.
The fine print. Ugh, that's never fun.
I know. But it's so important. Don't just blindly sign those documents. Take the time to carefully review all the terms and conditions. Make sure you truly understand what you're agreeing to. And don't be afraid to ask questions. If something is unclear, speak up. Your lender or real estate agent should be happy to clarify any doubts you may have.
That's such good advice. Knowledge is power, especially when it comes to something as big as buying a house.
Absolutely. The more informed you are, the better equipped you'll be to navigate the mortgage process and make sound financial decisions. Now, beyond just the numbers and the rates, let's not forget that buying a home is also a huge emotional decision. It's not just a transaction. It's about finding the right place for you to build a life. So don't get so caught up in the financials that you lose sight of the emotional aspect.
Right. It's about finding a space where you can really see yourself living and thriving, creating memories and feeling a sense of belonging.
Exactly. It's about finding that place where you can truly say, this is home. All right, let's shift gears a bit and talk about the bigger picture, the U.S. housing market and how it can impact mortgage rates. Because, everything's connected.
Oh, yeah. I'm really curious about this. What's the current state of the U.S. housing market? Is it a buyer's market or a seller's market?
Well, it really depends on the location. Real estate is all about location, right? But broadly speaking, it's been a seller's market in many areas for the past few years.
A seller's market, huh? That sounds like a tough landscape for buyers.
It can be. In a seller's market, there's typically low inventory, meaning there are fewer homes for sale than there are buyers looking to purchase. And that high demand, combined with limited supply, drives up prices.
Okay, that makes sense. So what are the main factors driving this trend? Why is there such low inventory?
A few things are at play here. First, we simply haven't been building enough new homes to keep up with population growth. There's a housing shortage in many parts of the country. And second, low mortgage rates in recent years have made borrowing more affordable, which has further fueled demand from buyers. It's like a perfect storm for sellers.
Wow, so it sounds like buyers need to be extra prepared and strategic in this competitive market. What advice would you give to someone trying to navigate a seller's market?
Preparation is key. Having that pre-approval we talked about earlier can be a huge advantage. It shows sellers that you're serious and ready to move quickly. And working with a skilled real estate agent can also give you an edge. They know the local market inside and out and can help you find the right property and negotiate effectively.
Okay, so being organized, decisive, and working with the right people can make a big difference. All right, now let's get to those mysterious mortgage rates. What factors influence their ups and downs? What makes them fluctuate so much?
It's a bit of a complex dance between various economic factors, things like inflation, economic growth, and the actions of the Federal Reserve. When the economy is strong and inflation is on the rise, rates tend to climb. And the Fed's decisions on short-term interest rates can also ripple out and impact mortgage rates.
Oh, so there's no magic crystal ball to predict mortgage rates. We can't just gaze into the future and know exactly where they're headed.
Sadly, no. But staying informed about current economic trends and working closely with a knowledgeable mortgage professional can help you make smart decisions, even in a fluctuating market.
That's reassuring. All right, so we've covered a lot of ground in this mortgage deep dive. As we wrap up this episode, what are some key takeaways you want our listeners to remember? What are the most important points to keep in mind when navigating the world of mortgages?
Well, I think the biggest takeaway is that knowledge really is power when it comes to mortgages. The more you understand about the different types of loans, the whole process, and those market factors we discussed, the better equipped you'll be to make informed decisions that align with your individual circumstances and goals.
Yeah, that's so true. It's not just about blindly signing papers. It's about being an active participant in the process, asking questions, and really understanding what you're getting into.
Absolutely. And at the end of the day, buying a home is a big decision, both financially and emotionally. It's more than just an investment. It's about finding the right place for you, a place where you can truly picture yourself building a life.
Yeah, it's about more than just the numbers and the rates. It's about finding a home where you can create memories and feel a sense of belonging.
Wow, talking about all this makes me want to start browsing some listings and maybe even schedule a few house tours. That's great. I love that enthusiasm. Just remember, take your time, do your research, and don't hesitate to reach out to those professionals. Real estate agents, mortgage lenders, they can be invaluable resources throughout the process.
Great advice. Well, this has been such an insightful deep dive. Thank you so much for joining me today and for sharing your expertise. You've really broken down some complex topics in a way that's clear and easy to understand.
It's been my pleasure. I'm always happy to demystify the world of mortgages and help people feel more confident and empowered as they embark on their homeownership journey.
And I know our listeners are going to appreciate that. I have a feeling they're going to walk away from this episode feeling a lot less intimidated by the whole mortgage process and much more prepared to tackle those next steps.
I hope so. And remember, if anyone out there has any questions, don't hesitate to reach out. We're always here to help.
Couldn't have said it better myself. Thanks again.
My pleasure.
All right, everyone, that wraps up our deep dive into USA mortgages and home loans. We hope you found this episode informative and helpful. Until next time, happy house hunting.
If this podcast helped you, don't forget to like, comment, and subscribe. Your support helps us keep making these videos. Thanks for watching.